Now let's actually start. Now,
All
based on
right.
the information that my guy actually have talked about, which is very important in trading, is the fundamental and technical analysis. Now, fundamental in the simple term means news, and technical means just based on demand and supply, you are analyzing the market. Now, when you talk about fundamental, the concept about fundamental is that fundamental is like predicting based on should I say rumor and figure, fact and figures that are hard. Now, to really enjoy fundamental, if somebody say I'm a fundamental trader, in other word, you can really put it in this simple term that you are a gambler in trading. Now, follow me carefully so that this will not be misunderstood. The gambling aspect that we mean here is that if you actually are wrong with what you thought the news outcome will be, and you have predicted in a particular direction, it can actually turn out to actually you can be wrong, and eventually it can actually be detrimental to your account, it can be catastrophic to your account. That's actually what I really mean by you are just like a pure gambler, because all you are just is based on what you think that okay, this where I think the market will actually react this way because this is what I expect the news to actually be. Because the news, you can actually have some kind of rumor. You can actually, based on fact and figures that you already put together by yourself, actually guess what direction the news will actually cause the market to fly. Now, if you are wrong with your news prediction, there is higher chances you will be also wrong with the direction of the market. And when fundamental really hit in the market, it is short-term stuff that actually happens. Okay, fundamental really happen on in a short term. Like it can actually move a market within an hour, sometimes less than an hour, maybe 15 minutes, or even sometime some news does not hold ground more than maybe 5 minutes. And the effect will be quick, swift, but may not be lasting at that moment. And then if you are actually a fundamental trader, you have to be somebody who is actually good at research, that is actually good at gathering data. Now, this is not really about studying the charts. I need to say that clearly and clearly. Fundamental is not first about you studying the charts. It is first about you getting informations around. Okay, how is people employment rate in United States currently? What are they complaining about people? Then I can actually predict how many people are out of job, how many people are actually in job. Okay, the way I see the reaction of people now, I believe that a lot of people are losing job. So because of that, non-farm payroll will actually be negative because there won't be more job added in the country because of the policy, governmental policy. Now, it's more about data around outside the chart that will have effect on the market. That is what fundamental is about. And technical, it is about you coming to the market to say, okay, what is exactly is the view that I can see from this market, and from what I can see, what is the direction I expect the market to take. Now, I need to also put this, even though we distinguish between technical and fundamental, on a long run, you will find out that there is a correlation between technical and fundamentals. In other words, you don't necessarily going to have uh, a technical analysis that will actually really go against the fundamental. Now, what did I mean by you don't necessarily have that? Is like this. I think somebody just try and join.
I'm the one. The network broke down. The call came in.
All right.
Stop it.
So now, if you look at it, why we said they might actually be somehow relevant to each other, both technical and fundamental, is that you find out that when you actually, let's use Nigeria as an example now. Uh, Based on the government that we have in the country, based on the policies and everything, you can predict the direction, the tone and direction of the chart. Because why? The governmental policy, the issue with interest rate, the issue with employment and unemployment always have effect on demand and supply.
Yeah.
If people believe that there is no favorable governmental policy in place that can favor your currency, it dwindle the demand for that kind of currency, because it will make investor to be skeptical about that. So in other words, it will have a tone of effect on the demand. When it does have a tone of effect on demand, on the chart, what will you see clearly? You will see also clearly the same effect, the resultant effect of that fundamental, even though this fundamental is supposed to be something like we said, that it's just something that's supposed to be sudden and just
Mm.
supposed to actually move market at a short period of time, and that we always have this mindset that it's a short period of time. Somehow it has a lasting effect on technicals. And because of that, it will affect the demand, it will affect the supply. And because it affects the demand and supply, somehow we can also say that there is somehow correlation between fundamental and technical. They are not necessarily completely distinct away from each other. Now, having said that, uh, for a trader to actually first of all start his journey, the best way to start your journey as a trader that want to actually not really make things complicated is to start with the one you can actually use your eyes to predict and actually have higher probability of winning. And that is technical. You
Yeah.
don't really need to actually so much desire to understand fundamental. Like the
Okay.
reason is because fundamental, like we said, demands that you actually get vast in data, fast in what is going on about policy and everything. And technical does not necessarily have to be like that. Technical means you must be able to see clearly when you open your eyes and see what the market is saying, and that by the sights that you can see that this is what the market is saying, you can predict where you believe the market is going. However, because we also understand that fundamental we have impact on the market, so what did you do? Whenever there is fundamental news that is about to be released, you stay off market. As simple as that.
Yeah.
It may be complicated that, oh, this and that. No. Go to Forex Factory, go to investing.com. All these places will show you the news related to the currency that you are trading, when it will be released. If the news is powerful, you will know that it can really have impact on the market. You will see high impact news, you will see low impact news. If you're using Forex Factory, for instance, high impact news will actually show you, I believe, three bull sign. And when they show you three bull sign, whether you are using investing.com or you are using Forest Factory, I believe investing.com will show you with bull easily. Now, you will actually have high impact news that actually show. Let's go to Forest Factory. I'm coming.
Okay. That's it.
Huh? The screen is not sharing. What's up? So you can see my screen now, right?
Yes.
Okay, so now this is forestfactory.com. Now, if you check based on all this news, this news is mid impact. This one is low, low. This is high impact news. This particular one, okay.
The one on red.
The red is high impact. This is mid.
Okay.
This is low.
Okay.
Now, it's as simple as that. That as a trader, when you actually look at all these news, they are not just there for your, on Forex Factory for joke. They are there to actually make things simply to simplify things for you, and to actually
Okay.
make life easy for you as a trader. Now, what did you need to do if you are somebody who is actually into technical analysis and not into fundamental. What you need to do as a technical trader is to actually come here to actually look at the time. Put it at according to your own timing because it will show you your timing here. It will show you your own timing here. If the timing here is not corresponding with your own timing, then you have to correct it to your timing in the settings. The settings is here. You can do all that here and actually correct that. Now, when you correct the timing to actually match your suit your time, which is correct now, this is 7:52 p.m. and you can see 7:52 p.m. Now, since we have 52 p.m., all this news is talking about the news today. Today is Friday. You can see Friday 29th. That's 12 uh 30 a.m., 12:50 a.m. all day, 2:30. Now, when I come here, I want to actually look at the news based on the currency I'm trading. Let's take, for instance, I'm trading GBP USD. Now, the currency that I will be concerned about their news is that I will come to GBP. I will not only stop at GBP, I will also go to USD because I am talking about GBP USD, not ordinary GBP. Now, when I come to this place and check the GBP news, I see that all this GBP news in the morning, there is no anyone that is high impact. You can see, obviously, meaning that even though they are going to have news released that day, they are not going to necessarily move the market. So I can analyze my market and actually trade. But something is going to happen in the afternoon. There is something that is very, very red, and that is called PCE. And I know that this will have effect on US dollar. And GBP USD is both Great Britain pound and US dollar. So if anything happens to US dollar, then there will be effect on GBP USD.
Yeah.
So automatically, what did I do? Every of my trading, I will try as much to make sure that whatsoever decision I'm going to make, I actually make them in the morning or before 1:30. So the moment I know that 1:30 is moving closer, maybe around 1 p.m., even if I'm running into loss, if I cannot actually uh close my trade, if I don't know, okay, maybe I'm actually having float negative trade at that particular time, that okay, I don't know where this news is headed and I don't want to close my trade, and maybe the trade is negative and I am saying okay, probably the news will still favor me. The best option would be to move all the money that I could not afford to risk away from that account. Leave the remaining one that I could afford to risk in that account till the news actually come and go. And if I could close, maybe in profit or in loss, I could close my trade before that time. The easiest thing, I would do that. Then I will
I
let
have a
you wait
question.
2 minutes. Okay.
My question is, since you said if you don't know what the news might come up with, either being negative or positive to you,
Okay.
you you have to move your phone from that account. What if you set your parameters very well, like your stop loss and all that, and you take
Okay.
profit? Will
Thank you.
it, because of the news, will it exceed your
Thank you.
stop loss
Thank
and
you
still
for
going negative more? Okay.
thank you for asking the question, and I do understand where your question is headed. But can you guys see my screen, right?
Yes.
Okay. Now,
Yes.
in the case of news, we call it when you have high impact news. What's
Mm,
supposed to naturally happen is that on a normal day, if you take trade, trade's supposed to stop if you stop at your stop loss. Yeah,
mm,
supposed to stop at your stop loss. But it's not the same since you are not trading directly in the market. You are using an intermediary and you're using a brokerage firm. Now, because you are using a brokerage firm will have to actually also execute the decision that you are actually making in the market for you. And because of that, there is, should I call what we call latency. There is no like immediately you actually did it that it immediately actually took effect. So in other words, that is what brokerage firm use as an excuse why an high impact news can cause a damage to your account even despite you have set a boundary of exposure. The boundary can be exceeded. Market can go far beyond where you expected on a
This is
normal day.
strange.
It's not strange
I'm
because
hearing this one for the first time. Sorry.
okay, because if it's going to favor you also, that is the same way it will.
Okay.
If it will favor you, that is the same way. Because when people actually complain most of the time, is because things does not go according to their plan. If things went as you planned, okay, you will not say the same thing. Now, not all news, not all high impact news will do what I just said. Many of them will stop you out at your stop loss, maybe a little bit above your stop loss. But there are some news that, like rate cuts. If you are talking about decision, I will advise that anybody should stay off, because what will happen is that markets will actually fly. You just see the market at a point and you see it at the next point. See,
It's
the
just like a
next point,
spike.
yes, the next point that the market spike to is going to be the point to which you are going to experience uh, that the market is going to wait. Now, example is this. There was a particular time I was trading. You guys should mute yourself. You are joining this meeting. Please mute yourself as we're joining. What kind of what kind of bad habit is this now? Mute yourself if you're just joining. It will be easy for all of you to hear me. Now, in the simple stuff, now there was a particular time I was actually trading, and there was Australia. Australia was going to make a decision about rate cuts, and I knew that at that moment it's going to favor Australia currency, and I actually that very morning I cannot forget. I sold uh euro is it euro AUD? I don't think it's Australia. I think it's New Zealand. I can't remember very well now. It's in New Zealand. I believe it should be New Zealand or Australia. One of the two. I took the trade and I sold maybe euro AUD or euro NZD. I cannot remember very well now. But any of that pair that was actually related with the news. So I sold. I penned another order. Now, when I sold, the market, the moment the decision of rate cut was actually made, the market spiked and my trade entered into massive profit, as in huge profit immediately. Now, I penned an order along the line. Where that market relaxed at that first spike was where my second pending order was activated. And because of high volatility, there was a pullback. And because of that, I have to close that second trade that was activated. I have to close it in negative. The one that was running earlier was already giving me about, I think, $200 profit. The one that got activated later was showing me about minus 40 something dollars, because it got activated at the place where the market relaxed after the spike. And after that relax, there was a little pullback first before the market continued dropping. So that pullback, I just closed both trade at that moment. Now, what I was trying to use that, why I'm trying to use that analogy was that that trade activated me where I paid the second order. That trade will be plus 200, the second one will be plus 140. But the second one was not plus 140, plus 140. Instead, it was activated at that point where the market spiked to before the pullback. And then when the pullback happened, instead of experiencing positive, I now experience negative on that particular trade. So if it going in your direction, that's the same way it will actually do. That it will not just immediately activate your take profit. If your take profit is set at, let's use gold as an example. Let me go back to, okay, let me still stay here. So if you're using gold as an example now, that okay, your gold was supposed to be activated and your gold was running and your TP is supposed to be activated, let's say at like what happened today that the market sold, that your take profit is supposed to be activated at 1950. If the market spiked to 1945 as you are selling, if the market spiked to 1945, it is that 1945 your take profit will be activated. Even though clearly in your parameter of take profit and stop loss, it will not change that they change the value for you. It will still show your 1950 take profit at your TV level. But when you check where the market took your profit for you, it will be at that 1945, giving you that 5 pips free of charge, because that is it's not going to be 5 pips, it's going to be 50 pips though. So giving you that 50 pips free of charge, because that is where the power of the news push the markets to. Now, just like we are seeing, let's keep and be on the focus, because I want to quickly go to the charts now. Now, if you actually look at that, what I just said now, and relate it with the market, so you can actually see high impact news can actually make you to experience or damage to your account, or go in more, beyond your expectation, to give you to deliver more profit for you than you even anticipated, based on whatsoever the outcome is. Now, for a very new beginner, the best option, just like we have said, is to avoid the news and actually trade just pure without news. And it's a very simple way to actually trade without news, is to come and check what time will be the news. And before the news, close your trade. Then after news, maybe 30 minutes, 1 hour after news, you can come back and look at opportunity that the market can give to you to actually trade. Because also in this meeting, I've talked about how eventually that news will also shape the market. Because it's not just new, it's affecting demand and supply. Even though technical analysis will tell you, and technical analysts will tell you that don't worry, it's just based on what you can see about demand and supply in the chart or on the chart. But the fact and the reality is that what will constitute all this buying and selling, even of all the institutional traders that you hear, that they tell you that they are the market mover, they call them the shark. See, what will make them to put their money in a particular direction is also based on the news that they already know. Nobody wants to bet against the direction of the market to just burn his money. So it's going to bet in the direction of the market, because somehow fundamental will actually have effect, because everybody will say, okay, this is where the government is going, this is where we have to go. So it's just as simple as that. So when you actually come here, then if you are somebody who want to take technical trade, you want to take fundamental trades, like the question can actually be, must I avoid this thing? No. In fact, you don't need to avoid it. If you want to take fundamental, but just like I have explained, it's just like gambling. What did you need to come here to do? Is to actually check. Okay, for instance, this call PCE, you can come here and touch it and ask question. It's just as simple. When you come here, you see they said it's on USD. Then you look at it, they told you about the forecast. If you go down, if you go like this, you will see the forecast, and see, they will tell you, okay, this is the actual. If you use your phone, it's just because I'm actually using my phone in a way that is showing the information under. Now, some of them will show it at the front. This is the actual, this is the forecast, this is the previous. Before this actual is released, you will see forecast, you will see previous. Now, you don't know how the market will go. Let's assume that we did not know how the market will go. And I want to say, okay, I want to trade it. So what are the information that I need to know? So I will just click on this thing. Then this will show me information, all the details that I need to know about what this thing is. And it will tell me what we see, the effect, usual effect, actual, greater than forecast is good for currency. That is, if what they release is actually greater than what was forecast or was forecasted, automatically it will help the currency. Now, in this case, you can see the one that was released today, the actual was lower than the forecast. So it does not supposed to help the currency. It's just as simple as that. So you just read that and you get the information. And from the information that you got there, then you can now go and predict the direction of the market. Now, the question will now be, what did you know that the actual will be? You don't know. And will they release the actual and you go and trade? The moment they release the actual, the market already start having effect. So if you are lucky, you can activate trade immediately the actual is actually released, that you take trade in the direction if the market have not started moving. But in most cases, the market would have started moving. In fact, your broker will actually tell you there are many orders that are actually on board that they will not fill you in on time and may even cause a big big damage to your account, because when they activate you, you are now buying at expensive price or you are selling at a cheaper rate, causing you to actually lose more in the market. That's why many people will trade before that time. Now, this is why you understand that it is like gambling, because I did not know what the actual will be. I just know that if the actual is like this, then it will favor me. If it is not, it does not favor. So I believe you understand now. So you can actually go here, know, then when you actually hear or you can read all the news of where people predicted that the thing will actually go, that will make you determine where you want to actually go, whether you want to bet against that currency or you want to bet in favor of that currency that you are talking about. Now, in the area of GBP USD, when you are betting against USD, you know that you are going to be buying, because USD is actually the counter pair at that is the quote, while GBP is actually the base. So the quote that is like the counter pair of the G, which is GU, that makes that GU, which is the Great Britain. That means that you will be buying if you are betting against US dollar and it's US dollar that wants to release news. So if you are betting in favor of US dollar, you will be selling because US dollar came later. So you will be selling that is going to favor it, just like that. So let's go back and actually look at the charts now. Now, I will quickly actually talk about support and resistance, which is a basic thing for everybody that come into trading, because all these things that we talk about news, you can see that that looks like gambling. If it's gambling, then is that what we are doing here? Not necessarily like that. We don't gamble. We come to technical and we trade based on technical. And on our trading based on technical, we understand that the fundamental will eventually have a long run also. But does not mean that at the moment we don't know where and where the market is going based on what we can see from the chart. Now, what you want to do in the easiest way of trading, a very simple way of trading, is to actually understand what support is. Support is the level below. As simple as that. Resistance is the level above. Now, all these things look very simple. It's just as simple as that. This 2018 is the resistance, which is the level above. This 1808 is the support, is the level below. If the market move from support, where is it going? Resistance. If the market move from resistance, where is it going? Support. Now, some of you will actually say, is this the resistance that we have here or the support that we have here? I am talking about just levels. Level below, level above that you can see. If you go to any time frame, this is weekly time frame. If I change from this weekly time frame and I change to 1 minute, I will pick resistance, I will pick support. What is resistance? Level below. What is support? What is resistance? Level above. What is support? Level below. So we have marked level below, which is support, and we have marked level above, which is resistance. It's as simple as that. Don't overcomplicate things in trading. Trading supposed not to be, is already a complicated stuff. So don't overcomplicate it. Okay? Don't make it much more difficult. Is it that we have somebody on board? So don't overcomplicate things. Make it more easier and more simpler for you. So you know that resistance is the level below, and resistance is the level above, and support is the level below. Now, and I said in a very simple term, if the market is going from resistance, where is it going? Support. If the market is going from support, where is it going? Resistance. On all time frame, you can find resistance, you can find support. And also a support can become a resistance can become a support. Now, today I want to really talk about 3 strategies, and I will quickly move on them. I've talked about fundamental that I've explained. Now, I know that that was not full details about fundamental, but to that extent, you can actually start gambling about fundamental and do research and get data, and it will not be gambling again. But you will have to know much about gathering data, like I've said. Now, but let's quickly look at this. That we're saying that support is level below, resistance is level above. Now, what did I also say? I said when the market move from the resistance, is going to support. When the market move from support, is going to resistance. Now, the easiest way that a trader, if you're a new beginner, to actually handle market is to go from higher time frame to lower time frame, and they call it top-down analysis. Now, what does top-down analysis mean? Is that you want to actually go to higher time frame to know where the market is headed directly. Then from there, you can come to lower time frame to now predict that the market is supposed to go this way, the market is supposed to go that way. Just like we have said today, support level below, resistance level above. So you go to higher time frame, you know where market is supposed to go. Then you come to lower time frame, you mark those levels that you expect market to get to. Simple. Then you make your decision based on that. Now, I'm not going to actually overcomplicate it. So let's go to higher time frame. Let's say I start from monthly. Very simple. The simple thing is that if I ask you, anybody that this eyes is open, if I ask you that this market, how does it look like? Obviously, this market look like the market is going up. It just started coming down because at this point, that's where we start having the market making ways to come down. But obviously, before that time, what you can see before that time is a going up market, is a buying market. But also something was obviously clear based on what we have talked about today is that we said that resistance is the level above. What did they call resistance based on the training that you have actually had? And I believe you're supposed to have done that in the terminologies. Now, resistance is where the market face resistance. It's just that same statement, resistance. When the market was going and face an opposition that force it not to continue going in that direction to start coming down. It's as simple as that. That's what resistance means. Now, where does this resistance is? You see the resistance is actually at this place that we have marked. Because market got to this area that we have marked, then the market started coming down. If you notice, I did not touch the wick of the candle. Candle contains both the body and the wick. Now, wick is not that important. It's important when you are setting stop loss. It's not important when you are using it to analyze. Because wick is just where market was dragged to. It's not where the real market got to. I will say it again. Wicks, like thread, or you call it shadow, is where market was dragged to, just like a manipulation of where market reach, but not exactly where the real market really reach. Just like people force market to an area, and as they said, let's say the benchmark of an iPhone is $2,000. iPhone 15 Pro Max, that is $2,000. That's the price. So because of demand, people push the price of iPhone to maybe $2,020, $2,050, or $2,100. Now the real price, the highest, is supposed to be 2,000, right? So what will happen? You notice that eventually it will return back to 2,000. Even though it pushed, when people see surge at that moment, all of them start selling it at $2,100. In short term, it's not going to last. It's going to return back to the price, which is 2,000. So when it returned back to the 2,000 was the real price that was meant. That $100 was just a price that people dragged it to. That 2,100 was the price that was dragged to. So that's exactly. Now, does not mean that people did not buy that phone at 2,001. That means also that does not mean that market does not get to that price that we're talking about. Market do get to that price, okay? Oh, market do get to that price, but even though market got to that price, it does not have that stability at those prices. And that is why in the real consideration, you don't consider weeks in your analysis. Because when you consider where market was just dragged to, you see you are considering where it's not that very important. So that's why I actually move the market to the body. That's what we call the body. You can see the body of the candle, not the wicks. You understand candle now, normal candle, where you have the body of the candle and the wick of the candle. Now you can see that that's the same way this was portrayed. Body and also the thread, the wick. Now I drag it to this area. You see that this 1987 is the real high of the market on a monthly basis. Does not mean that this is the real high on the 1 hour. This is based on the monthly. Remember, we're saying top-down analysis. Now, I've seen this on a monthly now. What is obvious to me now is that even though the market was an upward market before, market got to 1987 and started coming down. And as it started coming down, market make its way back to that 1987 and did not overcome 1987. So the resistance stand. Now, naturally, as a human being, we say when market actually move from resistance is coming to support. If you are somebody who has brain, who has sense, who did not want to complicate things for yourself on the monthly analysis, if they ask you where is the market headed, the way you are seeing, it's as simple as you just say, it's simple now that when the market is coming down, the first support level is at this area that we have. The next support area that we have is here. The next support is here, and the final support is here. Not overcomplicating thing, not overstressing thing. That they now said, what if you overcome that area? He said the next place is coming at these areas. It's just as simple as that, because we see that resistance is the level above, support is the level below. If the market is moving from resistance, it's coming to support. When the market is moving from support, it's going to resistance. So I mark those levels. Now, since you mark those levels on monthly basis, let's say the level that we mark is this, with this purple stuff, and this is the level. So let's say I remove all these ones. Now, I know that the market is coming to 1807. What is that? Is it going up or coming down? Market is coming down. Is it buy or sell? Sell. What should I do if I come to lower time frame? Then I will do like this on a lower time frame, maybe daily, maybe weekly, maybe 4 hours. I will know that market is going all the way to where? Let's go back to weekly. We know that market is coming to 1807. It's going to sell. Now, does that mean that I will jump into trade and start selling? No. The same way we actually analyze on the monthly basis, the same way we analyze on the lower time frame, because we know where the market is going, does not mean we should foolishly join inside, because market can go pull back all the way up towards this area and not even touch this area, but can pull all the way up to this area, and from pulling up to this area, it continues selling. If you have joined sell from here and the market started pulling back, does not necessarily mean that the market will not sell eventually. But because you hastily have joined into the trade, you eventually get, damage before the market start dropping to where you expected it to actually drop to. So what will I do if I come to lower time frame? Let's say on 1 hour now. Then I will mark those levels that we just mentioned again. Resistance, support. From here, I will start from here. Markets actually reach here. Then after that, this is the current experience of the market. Are you guys with me? Or am I the only one here? Hello?
I'm
With you.
following. I'm following.
All right.
Very interesting.
Now, if you come to lower time frame now, which is like 1 hour, now, not complicating things in a simple way. So, sorry. This last one. This is the where we mark currently, because this is the body of the candle. Now, the current candle that is showing green, that is pulling back, we have not really know where it's actually pulling to. Now, you see that I have marked a level, but that level is far away. Does it mean that we do not have another resistance before that area? We do now. They say resistance is the level that the market reached while market was going up and stop going up and start coming down. In a simple way, you see this market also from here going up, reach here and start coming down. So even though it's not a real major resistance, but it's also a resistance. So what will I do? I'll mark this level. Now, what is our ideal thing for me that want to sell? Would be that it will be safer for me to sell here from here than to sell from here. Because even though this market is expected to go down that level to that level that we predicted that the market is going to, the market can find its way to this area before it continue down. Now, if I have not been lucky to actually mark this level before, that I have marked it as a support here, and we see that the market break the support, turn it to support to resistance, and the market eventually get here, that I will now make my sell decision from here. If I have missed this opportunity of sell, I will not rush and sell here. Because if I am selling here, it's just like I'm selling at where I supposed to be buying. Now, but does it make sense for me to buy after I've seen on a weekly or a monthly basis that the market is going to sell? No, because if I am buying, even though because the market is at a support level and there is still possibility for the market to buy, if I am buying, I am trading against the direction of the market, which make no sense at all. The only thing that makes sense, that make logical sense, is that I actually wait for opportunity for sale. Now, what are the opportunity for sale? What are the scenario? To either wait here so that I can take my sell. Oh, maybe I should clear it and show where I mean. To wait here for my sell if the market did not break this area above. Because if it breaks this area above, I will be waiting again at another levels like here. I'll be waiting like here, waiting like here. It's just as simple as that. For a new beginner, don't complicate anything for yourself. Now, that is the option of where to wait. Or the market can break this area, the support that we already have, and go lower below the support. Then I will say, okay, yes, the market has break my support. Then let the market come back to that my support and give me opportunity to sell. Just like we have here, the market break the support. This is where the market we call support, where market reach and start going back up. This was support. The market started going back, but eventually break the support. Then as it broke the support, I did not rush to join sell. Even though I know it's a sell market, I did not join. What did I do? I waited at that area that the market will come all the way back up and I will sell. Now, some people will say, but what if the market did not come back? You will miss opportunity in the forex. You are not going to take all the trades. So you want to take the best trade, the best opportunity. You don't want to just risk and play gamble with your money. You want to make a decision that has high probability of winning. Now, since you want to make probability of winning, a high probability of winning trade, you are not in haste to actually make do of every opportunity that the market produce. Because always remember, if you lose your money, market will still produce opportunity. If you did not lose your money, market can produce opportunity for you to trade also. So in any decision you choose to make, market will still produce opportunity. So it will now be left to you to decide to rush in and lose your money. And when the opportunity now comes, you now see it with your eyes, you now miss it. Or you actually make do of that opportunity when it comes and actually take a higher probability trade and make money. Now, in a very simple way, we have talked about it, that this market have tendency to pull back to this area because that will be the safest point at this point for me to sell because we know it's going to sell. Now, since we know that that's the safest point for selling, I will be waiting. Now, I also know that there is probability that the market will go below 1846 or 1848 that we put it, 1848. There is probability for market to go below 1848. So if the market go below 1848, I'll say no problem. Then come back and touch 1848, give me opportunity and start selling, then I'll sell. Now, when the market also get back there, something that also happen most of the time is that because you are waiting that the market will get to that area, should not blind you to see the reaction of market when market get there. Many of the time, this I also fall victim of. Sometimes I would have patiently waited for market at a particular level and I will become so overconfident that I will bend my order and take trade. As in, I will not care about what the market is doing. Obviously, before my eyes like this, it's just because I was somehow convinced that that level will hold. But the truth is that if the level will hold, you will see in the market. If it will not hold, in most cases you will also see. In this case now, you can see now that the market make advance to go up, but fails by coming down. This candle, let me show you, this candle that ended as a red, show you one great information. It went up as a buy. This market started as a buy, seriously as a buy. Then that market ended as a sell. That should tell you the power of sellers. It's just full information, very simple information, very detailed information. A market that set out that I want to buy, then ended as a sell. What does that tell you? It tells you that the buyers just do as if they have power. Sellers show them who is in charge. So now, when the seller show who is in charge, I don't need any other conviction. Then I will sell. Now, is there guarantee that I will win? No. But is the probability of me winning high? Yes. Why did I say is there guarantee? You cannot promise and guarantee that you win all your trade. And we have said that, we have established that. Now, understanding that you cannot win on your trade will make you to make a decision that you know that the probability is high for you. Now, in this case, is the probability high? Yes. Why? I know the market is sell. I've checked it on the higher time frame. I've waited patiently. I've seen that the market has break a support and it has pulled down. And I've waited for the market to come back to that support that has been turned to resistance, and it gave me opportunity to sell. And I sold after I have seen that the sellers are in charge. Simple and well detailed information. Does that guarantee that you will now win? No. But will that actually increase my probability of winning? Yes. To what percentage? Probably 80 to 90%. The remaining 10% is where I might lose. And it's possible, and I accept. As a trader, it's possible to lose. And I accept it before I started trading it. So now I know that if I lose today, I cannot lose tomorrow with that same mindset. And if I lose tomorrow, I cannot lose next tomorrow with that same mindset. And with the mindset, I actually have the possibility of making good profit from the market. Now, I hope this makes sense. As the same way you look at it with a sell is the same way you look at it with a buy. Top down analysis. Go from higher time frame to study where and the direction the market is headed, then come to lower time frame to actually look for opportunities and wait for opportunity. If you have to wait, if you have to execute immediately, you execute immediately on a lower time frame to where the market is going. And advisably, you should trade only in the direction that the market is going. Don't bet against the direction. Just follow the flow. If you go to higher time frame and you did not see any direction, maybe you went to monthly, you went to weekly, the direction was not clear to you. That tells you wait till the direction is clear. As simple as that. Don't overcomplicate it. Don't overstretch yourself about it. You are at the beginning stage. You are going to learn other things that are much more going to help you. But based on the first information you are, master it, be best at it first, and execute wonderful trade from there. Then you can progress to the next level. Any question? Any questions? I want to talk about two more things. Two. So ask your question now if you have any questions so that I can respond. I have just about 20, or I don't know if this thing will allow the stuff to go 1 hour 30 minutes. Did anybody have any question? Are you guys here?
Yeah, thank you so far. It's been so impactful. Sorry to, is this class, is it recorded that
Of
we can
course.
make reference to? maybe afterward you still go through again.
It is recorded. Go ahead. I don't have much time. Ask your question.
All right. I think that would be all for now. I think I still need deeper understanding before asking further question. But so far, what you are teaching, I think, is entry.
All right. So now, in a simple, very simple way, you have seen the way we have approached this sell market. Go from higher time frame, come to lower time frame, wait for the at the right point and make your decision. Simple. Don't complicate it. If it is also a buy market that you check, when we check on that higher time frame, we also look for only buy. We rule the levels that we know the market will get to and make decision on market getting to that level. There is no whether you are advanced trader or a beginner trader, market that move from resistance is going to support. Whether they give you a liquidity zone, they can give you, they can call it different name for you. Market that move from resistance is coming to support. Market that move from support is going to resistance. It's as simple as that. When you are at the beginner level, you don't have to complicate it for yourself. Now, whether it's a buy, you will approach it that way. Whether it's a sell, you approach it the way we have shown. Now, let's leave the method of support resistance in trading. I think goodness, are you the one that did not mute in this meeting? Should you be the one not
Oh,
to mute?
sorry, I'm trying to mute. I'm trying. I don't know what.
So now, let's actually move on from the support resistance to another strategy that you can actually use to actually trade and make profit in the forex. And another one is indicator. Now, indicators can actually be two types. You can actually have a lagging indicator, and what do you call the second one? Is it logging or something? The first category is the one that it is after the market has moved in the direction that you follow. The second category are the ones that before the market move in that direction, you actually know, like you get to know and you make a decision to follow in that direction that the market is going. Is this thing making sense? Now, we'll be looking at a lagging indicator that is common, very common, and that is moving average. Now, people use moving average to trade. Sometimes people do moving average manipulation. What we call moving average manipulation is actually using beyond one moving average, combining multiple moving average, maybe one or two, and maybe two or three or more, to actually predict a direction of the market. Now, we don't have much time, so let's quickly talk about moving average. So you go to this on your chart. How to locate moving average is just simple. You actually click your chart like this, and you have all this information. Then you can actually come here and make it very simple. This is where you have all the objects that I just showed you today that I was using to mark level. This, okay, okay, I will get to Fibonacci later. This, I was expecting people to actually ask me that question in before, but you did not ask. That all these lines, all this stuff that I was drawing, that I was using to mark levels, where will you find it? How did I get it? How I got it is this triangle, rectangle, circle that you can see here. That's where I got it to. So anytime you need, you can actually pick from there. Okay. Then you actually click on this sign that looks like dollar sign that is not really a dollar sign. When you click on it, that's when you have indicator list information. Now, you can see that now I don't have any indicator. So you can see my main chart, everything is clear. But at the front, you can see F plus. If you are using an iPhone, I think whether you will see F or you will see plus, one of it. So let's click on F plus. Now on the F plus, we have all the indicators that we have, all their categories. Now in this category, the one we want to look at is a trend one, which is the moving average. Now, moving average, let's use 50. Now, the period is the 50 that I'm talking about. The method is simple, and I will quickly talk about two different type of moving average before I move on. Now, we have period 50. The higher the period, it's actually talking about the higher number of candlestick combinations. Now, you can see that I put it on 50 period. That means averaging, directional averaging of 50 consecutive candles. Now, that is the simplest way of actually putting it. In what I'm saying in essence is that on 1 hour time frame like this, as I put this moving average on 50 period, what it means is that it did averaging of 50 candlestick, and they actually use it to predict the trend, the direction of the market. If I put it as one, that period as one, it will use one candlestick. That each candlestick, then the average, which is just one, average of one is one. You understand now? Now, when you ask me that what averaging did I mean, it means that it actually combining all those candles, their lengths together and dividing them to actually average what is the total, way that it seems the market is headed to get average. I think you're supposed to know when you are in school, they're supposed to teach you mean median mode. So if they did not teach you mean median mode in your primary school, this is where you learn mean median mode again. You go and find mathematics topic that will teach you mean median mode. So that's what we are talking about mean in this area, averaging. Now, you have seen now, higher period now, you see the way the market show the direction of the market. Now, I will go to another one. I will go and add another one now. I'll click the same thing. Then I will not change this one. I will not click on this moving average. I will add another one. Completely one moving average. Instead of putting 50, let's put 7. You can use any figure. I'm just using 7 in this case as simple. Then I click on done. You will see difference. Oh, let's change color. I did not remember to change the color so that we will distinguish between each one. So this one is black. Now let's check what happened. Do you see the averaging of this one of 7? Do you see how we follow the market? Now, many of you will say, oh, this 7 quickly show me now that I can follow the market now. Yes, it shows you the averaging of how the market is headed based on 7 candles on 1 hour time frame. But the 50 shows you overall. Now, in a simple way that we call moving average manipulation, people that trade with moving average manipulation will be selling markets here. They will be selling here after both of them cross here. Because why? You can see the 7 cross below towards the downside, cross below of the 50 moving average. So automatically, what will I be selling? That the market is coming down, I will be selling. If the 7 cross above, it means the market is going up. So I will actually buy. In this case, they will be selling around this period because 50 moving average was actually confirmed. Now, if you are using one independent moving average, even if you are combining moving average together, I need to say this that is very important. When market cross moving average, wait for market to return that to that moving average. Let the moving average serve like a resistance or support where you take your trade. You remember when we did the analysis of the support resistance the other time? Did you remember that I waited for the market to pull back? I did not just join because the market has started selling, has crossed below a support, and I said, I know the market is going down, so I sold. I did not do that. I said we will wait for that market to pull back. Then when it gets to that resistance and it confirms that you want to sell, then we sell. The same way if you are actually using moving average. Now you can actually ask me that how is that applicable to moving average? Let me show you how is exactly applicable to moving average. In this area, you see the market, this candle coming all the way down. This candle crossed this moving average down here. Now, if I'm using ordinary 7 moving average, that I'm not even combining 50 moving average at all. If I'm using ordinary 7 moving average, I will not join this sell when they cross this 7 moving average. This is the 7 moving average. You cross it from here. And all the way it was selling. I will not sell. The only way I will sell is when it pull back to this level. Do you see it now? That it pull back at this level, it does not even touch the moving average, the 7 moving average. Where does it touch the 7 moving average? Here. When it seems to break it above, but did not successfully break it above, the candle ended as a sell. Then I will be selling from here. Because now the market has touched, like market has returned back to my resistance and has touched it and has confirmed for me to now sell, then I will sell. Now, if you are actually now saying moving average crossover, we are using both 50 and 7. Where will I actually make a decision? It's simple now. You can look at it here. Both of them cross here. The only way market eventually confirm entry for itself was here. When the market did not successfully break them above and the market come down. Then from here, I can start selling market and go down. Then I will be setting my stop loss above here, where the market reach the high. You remember resistance, that market go from resistance to support. Now, since we have now established that this is now our resistance level, then I will set my stop loss there, expect my markets to come to support. As simple as that. Did anybody have question? I've finished with moving average. I want to just quickly talk about different type of moving average here. Then, if you have any questions, so I can quickly answer before I talk about two different type of moving averages. Did anybody have any question? Is this meeting still going on? Or am I the only one?
Yeah, we are still following.
All right. Any question? Quickly. Any question?
Not for now. I don't have.
All right. So if you don't have any question, okay. So let's move on. Now, in moving average,
I
remember.
have a question.
Okay, go ahead. If you have any question, quickly ask me.
You said before you enter the market, you analyze from the monthly time frame, which is the higher time frame,
I did
the
not say
monthly
monthly. I said go
and
to
down
higher time
top-down
frame.
analysis.
I
Okay.
did not say you must do monthly. I just say ideally go to higher time frame that goes beyond that time frame that you are executing trade from. So you can just stay at
Okay.
on the confine of just daily. You can stay at the confine of weekly. You may not go beyond that, but go to a time
Okay.
frame that is far above the time frame that you are making decision from, because you want to actually make a decision that is in line with the overall direction that you can see on higher time frame, that the market is not going to rule out all of a sudden. Because when you see a clear direction on higher time frame, like if I'm making a decision on 5 minutes, let me quickly say this. If I'm making a decision on 5 minutes, if I see a clear sell on 4 hours, see, let me tell you this. If the market has not reached the real level that the market is supposed to reach, on 5 minutes, that market is going to sell low. It may be buying at that moment, and I may make mistake of rushing into trade and lose money because I rushed in. Hello, you can mute
I'm
and
with you.
listen now. Now, if the market actually pull back and I lose money, that will be because of I rush into trade. Just like I show you, now the market that break a level, I don't rush inside. I supposed to wait and let it go up, then I will enter. Now, if I did not rush in, if I allow the market to finish all the nonsense of buying that the 5 minutes is showing me to get to the major level and confirm a sell, let me tell you, there is higher chances that the market is going to sell, because I have seen it clearly on 4 hours that that market is going to sell and it has not reached the level that it will reach on a selling level. So it's not like you must make sure you go from monthly. It can just be somebody wants to decide on 1 minute and 5 minutes that have to go. You have to go to 4 hours at least. You have to go to 4 hours because 4 hours is a bigger time frame that 1 minute and 5 minutes cannot just rule out all of a sudden. It's not possible. So if you are actually somebody who is a day trader and not a scalper, you can actually go on a daily time frame, analyze the market or and weekly, understand the direction. Then when you come to daily time frame, just wait at the right point. Take your decision based on the direction of the higher time frame and enter at the right point. Just relax. In most cases, you will win. In most, I did not say all the time. In most cases, you win. Even sometimes that you will lose will be probably that the market just hunted you out and continue in your direction. In most cases, you will win. Okay, so you can quickly ask your question now.
Okay.
Hello.
On 15 minutes. If you are making decision on 15 minutes,
Yes.
are you saying we should go on a 4 hours?
Okay. You're asking me if
Is
I'm
4 hours
seeing.
okay for 15 minutes?
Okay, you're asking me if 4 hours is okay for
I'm
15
asking if
minutes.
4 hours is okay for 15 minutes.
Okay. See, any time frame can be okay. If you actually go to 4 hours, the question is, do you see a clear direction on 4 hours? Yes. If you see a clear direction on 4 hours, why not? If you see a clear direction and you are sure that you see a clear direction. But the point is that why did you not even want to go beyond 4 hours to like daily? Because if you go to daily time frame and you see a clear direction and you know the level the market is going to go, and the 4 hours agree with it make you become more safer in your decision making than to just say, I just check 4 hours and I'm sure. Whereas you may not be sure. Because sometimes, like I told you, sometimes you may think that you've analyzed completely and you understand the market. And that's why sometimes when you lose, including professionals, when they lose some trade, they just go back and check. They just say, oh, and I thought this. So this is a mistake that I actually made. They will see that it's not like the market just that there was manipulation. It's they that make a simple error from their hand. So sometimes you may think you've seen a clear direction like on 4 hours. But if you check on daily, you'll be able to say, oh, no, no, no. What I thought I'm seeing wrongly. Oh. Then you can calm down. But if you can see clearly on 4 hours, why not? Make your decision on 15 minutes, streamline your decision, just act on 15 minutes. And just like we have talked about, if you are using a strategy that you have traded 10 trades, you have used that methodology that, okay, I will always go to 4 hours and analyze, and I come to 15 minutes or 5 minutes to execute my trade. And out of my 10 trade, I win 7. Nobody needs to tell you that that strategy works for you. Let anybody see anything they like. That strategy already worked for you. Most of the time, problem is that people just think because they told me to do this, I did it, I thought one day I will win. No, it does not work that way. You also have to actually check if that thing that you are doing is actually paying off by the reason of the result that you are seeing on your account. It's just as simple as that. You have to measure it based on the performance on your account. That's why it's not good enough to just only assume and analyze in your head. Execute so that you can see result and measure your result and say, yes, my strategy makes sense. No, my strategy does not make sense. There's no how sweet they may sweet talk you to actually accept that strategy. If you check it out and it does not make sense, just discard it. As simple as that. Did I answer your question so that I can go on?
Yes, sir.
All right. Now, finally, in the area of moving average, let's talk about 2-day moving average. Remember, I was pointing your attention to actually see that the moving average was simple. I'll go back and show you. Oh, sorry. I'll go back and show you. This is the moving average. You can see the period 50, and you can see here method simple. If I change from simple, I change it to exponential. Now, there's something we have 4 types at that point, but the most common use is exponential and moving and simple. Now, what is the difference between exponential and simple? Exponential means you actually do the market exponentially, and what I believe that exponential actually means that it relates to the current candlestick, not the previous historical candlesticks alone. Now I'll say it again. The exponential moving average, when you put the moving average on exponential, I believe what it means is that it counted the fee. If we are using like 50 now, we're talking about, if the period is 50, it's counting candles, 50 candles up to the current candle. That is what exponential is doing. But when it comes to simple, it's counting historical 50 candles. They are not the same. They are almost the same, but they are not the same. One is counting to the current. One is counting the history. Now, why they almost look the same is that you can see that they are not far apart now. One is just only counting till now. One is not counting till now. It counted before now. One is counting till now. Now, that is why when you actually put your moving average away from simple to exponential, you see that it seems as if market seems to move closer to the moving average in most cases. Now, open your eyes to look at this chart very well. Open your eyes to see this chart very well. The blue is the simple moving average of 50. The black is the moving average of 7. Both of them simple. I want to add 50 exponential moving average to this thing. Just because of my time, that's why I will just add 50 exponential so that you can actually understand it. Now, this 50, instead of simple, I'll put it on exponential. To differentiate, I'm going to change the color. Let's put it as red. Then done. Then go to the chart. Did you see what I say? You see that in this place, it seems as if this red is closer than the blue. You can see it seems to move closer, far closer to the candles than the blue. In most cases, you can see that the 50 moving average seems to be like a lower moving average than 50 on exponential compared to simple. And if you check them, they are almost very closer, more to the candles, far than the simple moving average. If you put it on for the 7 also, this is how you will also see that it actually so adjusts to the chart and everything. Now, that distinguish between exponential moving average and simple moving average. I want to cover Fibonacci retracements and Fibonacci extension before. I cannot. This is just 5 minutes to 9. I need to actually end here. Sorry. I was trying to rush so that I can cover that, but I want to allow you guys to ask questions and understand, and many of you did not join on time. So I'm going to actually pause and end the meeting here. This is over 1 hour. This is about 1 hour 20 minutes spent already for the live stream. Now, if anybody have any question, you can actually ask me now. I will actually end it here. Probably I will actually do video on Fibonacci retracement, and that will make 3 strategies that we have talked about. Just simple support resistance, and which is top-down analysis. We talk about moving average, and that will be the third one, which will be Fibonacci tools. So Fibonacci is not complex, but it will take me more than 4 minutes. There's no way I want to rush it. It will take me more than 4 minutes, so I will end it here. Any question?